All right. Thank you everyone for joining us today. My name is Melinda Smith and I am here with you from Freedom Network USA, who is co-hosting this webinar with our member and partner, the Human Trafficking Legal Center. I'd like to welcome everyone to the call and we are thrilled to have everyone here today to talk tax planning for survivor consultants. We have two amazing speakers here who have agreed to offer their expertise on this issue and help all of us better understand our tax obligations as independent consultants. I'd like to welcome Martina Vandenberg from the Human Trafficking Legal Center, who will be our moderator today.
Thank you, Melinda. So we, as Melinda said, are really fortunate to have two excellent tax attorneys to provide this session today. So let me just briefly introduce both of them, and then I'm going to hand the baton for the first portion of the webinar. Kathleen Saunders Gregor, who goes by Kat, is a tax partner and co-founder of the tax controversy group at Ropes and Gray law firm in Boston. We know Kat very well because Kat has done extensive pro bono tax work for trafficking survivors throughout the United States. She generally represents large corporations and investors and private companies before the IRS and U.S. Tax Court and the U.S. Court of Federal Claims. And she previously practiced as a CPA with PricewaterhouseCoopers, an accounting firm. So we're very happy to have Kat today because Kat brings a wealth of knowledge and experience to this discussion. The second speaker is John Snyder, who goes by Jack. Jack is an adjunct faculty member at the University of Baltimore Law School, where he also serves as the university's low-income taxpayer clinic director under a grant from the Internal Revenue Service. And I think Jack is going to talk to you about the low-income taxpayer clinics, which exist throughout the country and can be enormously helpful for people who are trying to file their taxes properly and stay on the right side of the IRS. He does supervision of students who also provide tax advice to taxpayers. He assigns cases and he teaches a weekly seminar on tax preparation and work on tax cases. So he's going to do the portion on tax controversy. So if you're having difficulties with the IRS, and Kat, who's going to lead us off, is going to talk about planning of taxes so that you don't get foul of the IRS in the first place. So Kat, with that, I'm going to turn it over to you.
Great. Thank you, Martina. So we are going to start this off with a very basic point, but one that everybody who is a consultant is sort of the first question people will need to ask, which is, am I a employee or an independent contractor? This distinction in the tax world dramatically affects how you are treated for calculating your taxes for the IRS and also for states. So it's very important to do. So a couple basic things first. You want to just jump to the next slide? There's not a lot there, but a couple basic things first is that whether you're an employee or an independent contractor affects how you pay your tax, and also how much of your tax you are responsible for versus your employer or the business that is paying you for your services. And also your employer or your client is actually the one who is required first and foremost to make this determination. And so it's something that is important to think about when you take on a new position of any sort up front when you first take on the position, because you will want to ensure that if you believe that you are an employee of a company, that company is meeting all of its employer obligations. And vice versa, if they're going to treat you as an independent contractor, that will change how you need to report your taxes. So it will be important for you to know up front. So if we can just click through, yep. So the first question is, how do I tell? And there are several factors that the IRS looks at. when they're trying to figure out whether a worker is an employee or an independent contractor. And there's a lot of IRS guidance on this point that is put out on the IRS's website, but at a very basic level, I tried to distill it down into three main points. Just first and foremost, is the work that you're performing, is it controlled by the employer? Does the employer tell you what your hours are? Do they expect that you're in the office at a predictable, constant time? Do they have the authority to come in and say, well, I know you're working on this project, I want you to do it this way? Or are they just interested in the end result, which is, depending on what type of work you're doing, could be, are they interested in you just doing the preparatory work yourself and then speaking at a conference? That may be different than if you're coming in every day and working on a presentation for someone else. The next question is, how are you paid? Do they reimburse your expenses? Is it a salary, a weekly or monthly salary? And is your employer, or is this particular client, your primary source of revenue, or do you have many different clients? And then really just sort of, how do you describe the relationship? How do you think of the relationship? Is it a permanent? Do you think of it as your job? Is your employer providing benefits, like insurance or pension plan, vacation pay, that kind of thing? If those types of factors are present, then the IRS likely will want to say that you're an employee. And then going ahead to the next slide, it really, the reason why, and I'll take a step back, the IRS prefers to see people treated as employees, if in fact they are employees, because the employer is required to withhold income tax and calculate your Social Security and Medicare tax themselves and then remit that quarterly. So the IRS gets their money on a more predictable basis, and they have an additional person that they can go after if for some reason you did not pay your taxes. So the IRS typically tries to argue that more people are employees than are not, but there are plenty of people who are truly independent contractors who only perform work on a project-by-project basis and are paid like an independent contractor. And so if that's the case, then you as an independent contractor actually are you're the only one who's responsible for paying your taxes. You will not have your employer or your client withholding income tax for you, nor will they be paying a portion of your Social Security and Medicare tax. Rather, you will be responsible for paying the entirety of your Social Security and Medicare tax. And then from a reporting perspective, it's a little different. Your employer would give you a W-2, and as an independent contractor, your client would give you a 1099. So from there, let's talk about what it means to be an employee. So if you're an employee, like I mentioned, you have to provide some documentation, and you need to talk to your employer about being an employee up front. We're going to go through a couple of the common forms. Sorry, I'm taking a drink of water. A couple of the common forms that employees will be asked to fill out. The first is a Form W-4, and the employer asks for this at the beginning of an employment relationship to determine how much tax to withhold. So in other words, if you are a person who is married and you file your tax return jointly with your spouse and you have several dependents, you may need to have less tax withheld from your paycheck than if you were a single person with no dependents. You may also be asked to provide this form occasionally. You may be asked to update it if your status changes or if the employer is reviewing its paperwork. And if you skip to the next slide, we will show you what this looks like. It's a pretty straightforward short form, and if you get a copy of it from an employer, it actually comes with what we have here is a screenshot just of the short form itself, but it will come with instructions that will tell you how to calculate things like the number of allowances that you're claiming. And that those allowances is the number of sort of, if you will, credits that you get for the IRS and your employer to calculate how much income tax needs to be withheld. And then if we skip forward to the next one, this sheet, as I mentioned, this is also part of the W-4 instructions, but this sheet is actually just walks through how you calculate your allowances. So as you can see, you get to add one for yourself, and then also if you are married, filing jointly, you add another allowance, and then separately, if you have children and your income is below a certain amount, you will get several more allowances. Let's skip to the next slide. So in addition to a W-4, your employer likely will also ask for a Form W-9, possibly also a Form W-8, although typically for people who are here in the U.S. permanently and not on a temporary basis, we'll be providing a Form W-9. And what that form does is it confirms that you're a U.S. person or a U.S. resident alien, and it informs your employer that you're not subject to backup withholding, which is generally applies when you have a prior tax, either prior taxes that you didn't report or had failed to pay, and the IRS basically notifies you that you have to subject any future earnings to backup withholding. And again, this is typically requested when you're hired. So those two forms typically will come together, a W-4 and a W-9, in your new hire paperwork if you're an employee. And here's just a copy of the W-9. As you can see, it's a pretty straightforward form, except it's one that applies to individuals as well as businesses. So if you are, we assume everybody on the call today is an individual who's working for themselves, but if you're an individual, it's a relatively straightforward. You just put your name in, your social security number or taxpayer ID number, and then check that you're an individual and confirm. We just put the top part of the form here, but as you'll see below, it asks that you confirm at the bottom of the form that you're a U.S. person or U.S. resident alien. And then after you've been employed, what will happen is your employer will use the new hire forms that you prepared and filed. They will calculate how much needs to be withheld from each paycheck. You will receive your paychecks with withholding taken out of the form. And then at the end of the year, you'll get what's called a Form W-2. And this is, and there also would probably be one that would be provided based on your individual state. And a Form W-2 is reports both to you and to your employer the total amount of earnings that you made for the year, but also the amount of taxes withheld during the year. So the IRS can look at that and confirm that both the right amount of Social Security tax was withheld, but also will use that to compare against your tax return. And you also will use this form in order to prepare your tax return at the end of the year. So this is just a screenshot of a sample W-2 pulled off the internet. And as you can see, it shows your federal wages and then also your Social Security and Medicare wages. Some people end up having some types of wages that are exempt from Social Security and Medicare, so sometimes those numbers are a little bit different. And then from there, what you end up with, it will go through a lot of other information, like whether you're eligible for a retirement plan. But the important thing is that it lists both your taxable income in box 1, but it also lists in box 2 your federal income tax that was withheld that you would be able to report on your tax return, and then also your Social Security and Medicare tax, which the IRS will be checking to make sure that the right amount was collected from your pay. In addition, if you look at the very bottom of the form, it shows that your states and some localities will be listed here as well. This is important. Sometimes you will simply attach your W-2 or use this information for your states as well, but also it's important for some of this information will make its way onto your federal tax return as well. We can click to the next one now, thanks. So then the question becomes, how is this different for consultants or independent contractors? And so remember, as an independent contractor, you're more, just sort of definitionally more independent from your client or the business that's hiring you. And so they have less obligations. They are still required to confirm that you're a U.S. person and not subject to backup withholding, which I described before. So they will still ask you for the Form W-9 that we went through earlier. But because they do not do income tax withholding or Social Security tax withholding, the business generally would not ask for a Form W-4. So it'll be less paperwork if you are an independent contractor. And again, here's the W-9, which we showed you earlier, so we don't need to spend much time on before. So then once you are working as an independent contractor during the year, you will be getting paid, but you will be getting paid, generally speaking, the gross amount that you earn. In other words, if you agree to do something and the client says, I will pay you $1,000 for that project, however long it takes you, at the end of the project, you'll get a check for $1,000, assuming all goes according to plan. There won't be anything withheld from that. So we're going to talk in a second about how to pay your taxes during the course of the year. But at the end of the year, one big difference between between an independent contractor and an employee is that independent contractors receive a Form 1099 and not a Form W-2. All this does is tells the IRS that you earned money, but there is not, as you'll see in a second when we click over to it, there is no line for well, there is a line for amount of taxes held. Generally, that will be blank. And there's nothing relating to Social Security or Medicare. So generally what you'll receive is a Form 1099 that will simply state that you earned or you were paid a certain amount of money, and it'll be up to you to report on your tax return what the amount of tax is on that. There are times that if an individual were to hire someone as an independent contractor and that individual didn't hire that person in the conduct of their business, they may not be obligated to provide a 1099. But we did want to make sure everybody still understands that if you are earning money, regardless of whether it is from an individual who does not have an obligation to report it to the IRS versus a business that would have the obligation to report it to the IRS, it's still taxable income, and you're still obligated as a taxpayer to report the income on your tax return. So we'll just look at the 1099. So as you can see, a 1099, it looks a bit different than a W-2. It still has your name, your Social Security number, and the payer's name and taxpayer ID. But generally what you'll see is a bunch of lines. And typically we would expect that if you were to be paid for performing services, it will go in box 7, non-employee compensation. And then at the bottom, there may be additional information. If for some reason they did withhold some kind of tax, they may put that in some of these boxes at the bottom. But generally speaking, you may get a form that the only thing filled out is line 7, non-employee compensation. And from there, you would need to take that income and report it on your tax return. So a minute ago, I mentioned that you will be responsible for putting in your own estimated taxes, or you're paying your own taxes. There are 2 ways to do this, and you can do this. So just to take a step back, just very practically, the 2 ways you can do this is, one, you can take a form that you can download off of the internet, which we will show you in a second, or you can sign up to pay it online. Either is fine. Technically, you're paying your estimated taxes with a Form 1040-ES. Even if you're doing it online, they'll ask you to identify what form and what years you're paying it for. So no matter how you end up doing it, we do recommend paying your taxes quarterly, even if that means you end up with a refund at the end of the year. And the reason why this is very important, first, is in many circumstances, if you are an independent contractor, very first and foremost, you are obligated to pay an estimated taxes if you meet certain thresholds. Often it is hard to know whether you'll meet those thresholds or not at the beginning of the year. So if at the end of the year you had been obligated to make estimated payments, you could be subjected to additional interest and penalties if you had not done so. And so often the last thing we want to do is have people think that they're saving money or delaying a payment, and at the end of the day ending up having to pay more because of interest and penalties. And then secondly, it's also it's a very good way, just like withholding, if you're an employee, sometimes people will have amounts withheld a little bit more than they might otherwise to sort of force themselves to save. I often think of my quarterly estimated taxes, which I myself have to pay, as a way of sort of having a potential, a potential refund check in April, right about when I go on a vacation or take some time off, or something, that you can use to save and stock away in a bank account later when you get the refund. But it's really important to go ahead and do it. And the right amount to put in can vary greatly depending on how much money you're making. But at a minimum, we generally will suggest that people put in there's a 15% of your earnings, and I'm just speaking about federal right now, but there's 15% of your earnings that will have to go to Social Security and Medicare tax, or about that. And in addition to that, we typically suggest that people put in another 5% or so for federal at a minimum. You should talk to your accountants, because depending on your income level, it may be much higher. And then also you'll need to do an amount for your state as well, which we can get to in a second. States vary a lot, state by state, but we typically will suggest that people put in estimated taxes for their states. So clicking ahead to the next, so this is some of the information that's on the IRS's website. In part, we wanted you to see that there's a website at the bottom that shows you where to go to download the Form 1040-ES. Your state will also require, or generally will require, that you look at the correct form or pay it online. So you can just Google your state and estimated tax payments to see what the right amount is, or we're going to talk later towards the end about how to get assistance preparing your tax returns. People who can help you prepare your tax returns also can give you the right state vouchers as well. And so then if you click forward, yep, here's the form itself. As you can see, there's a number at the top. We screenshotted payment voucher number 4. That would mean that it's for the 4th quarter. But really, if you were to print out the entire form, you would see that there are 4 of these vouchers. So the intention is that you're paying on a quarterly basis. The first payment is due April 15th. The second is June 15th. The third is September 15th. And then the 4th is January 15th. And so those dates are important. And there are calculations that people should be doing to figure out exactly how much to go in. But again, we'll get into it in a second. But you will need to do that on a quarterly basis. And in addition, there are as you can see in this form, on the form that we've screenshotted itself, you can see that if you're writing a check, there's a specific way that you would fill out the check. If you were to do it online, in the instructions, there are places where you can go online, do it online with your bank account number. And that you can do as well. Also in the instructions, if you're paying with a check, it will tell you based on the state that you live in where the estimated tax payments need to go. So all of that can be is in the instructions to the Form 1040 ES, which you can, the prior slide showed the web address. So
Kat, can I just jump in for 1 second? This is Martina. How would you, if someone mails this with a check and they write their social security number on the check and they send it in to the proper office based on where they live, would you recommend sending it certified mail or registered mail or making copies of it? What can you do to ensure that you have proof that the IRS received it?
Yeah, so we generally, thank you. Maybe didn't even end up in our slides at all. So typically we recommend any form of certified mail or anything that has a tracking number on it so that you can show that it was delivered later, but that also has a proof of filing. So everything, when I say it needs to be paid by January 15th in the example of this quarter 4 voucher, it actually needs to be postmarked by January 15th. So you would need to go to the post office and get it postmarked. So you'd want both the certified mail that shows that you have the postmark receipt on it, as well as then the certified mail would give you the proof that it got received by the right agency. And then typically we also recommend that people keep copies of the check and the form. And that's if there was ever any question, if the IRS didn't receive it, you would at least be able to use the check number at the bottom to trace through your bank account as well.
And then one more question. So say I earn $1,000 in the first quarter as a consultant, but I earn nothing in the second quarter as a consultant. Do I have to make 4 estimated quarterly payments a year, or can I pay estimated payments only in those quarters where I actually earn any money? Do I still have to file if I have nothing to report?
So that's a good question. It's the way the calculation works is it takes what you make, say in the first quarter, in your example, 1,000, and then it assumes for the first quarter, just talking about the first quarter now, it assumes that you're going to make about the same amount for the rest of the 4 quarters. So it would imply that you would have a $4,000 earnings for the whole year, but then it backs into, well, you only need to pay the first quarter now. So it would affect what you're doing is paying just on what you already had. So assuming that you paid, and in the next slide, we actually recommended paying 22% of your earnings each quarter for federal purposes. So assuming that you put in 22% of that $1,000 by April 15th, of the year that you're earning it, but then you don't earn anything in the second quarter, then what would happen is the calculation would just say, oh, well, now your estimated tax for the whole year is a little bit lower, but you paid in something that was enough to cover what that lower amount is. So it would calculate so that you didn't have anything to pay on in the second quarter. So really you should just, a rule of thumb is pay based on what you've earned.
Great. And if people have more questions, they can send them to us in the chat box, as Melinda said. Thank you, Kat. That's really helpful.
Great. And so, so I think I've covered all this already, but again, as we recommended, we suggest that you pay 22% of your earnings each quarter in estimated tax for the federal. And that's sort of based on a rule of thumb of the 15% Social Security and Medicare tax plus an additional amount for income tax. It may be higher or less depending on what your income is. So if you have a tax advisor that is advising you based on your own circumstances, certainly rely on what that person tells you. And you may be able to get a refund back. Again, as I mentioned before, and we can click to the next slide now. Sorry, I keep clicking through on my own printouts and forgetting to look up what's on the screen. Again, you also will have to do this for your state as well. Now, typically, you pay state taxes on anything that you earn. Most often, it is taxable by your resident state, so where you live. But you also can be obligated to pay tax in a state where you work. So, if you fly to another state for a speaking presentation or to work on a very specific project, and you're there long enough, that state may decide that you need to pay some tax to that state. Normally it works out, so you're not paying tax twice. If you have to pay tax in a state other than your resident state, your resident state will typically give you a credit, so you're not out of pocket more money than you otherwise would have been. But it can get pretty complicated quickly. So if you are working as a consultant and you're moving around a bit, again, this is one of those areas where you will want to reach out to someone, certainly by tax time, when it's time to prepare your tax return, to get help figuring out how to do it. And now the last area that I'm going to cover, and Martina, I'm assuming you're going to interrupt me if you see more questions, but the last area I'm going to cover before handing it off to Jack is just some tips for when it comes to the end of the year to prepare your tax return. So if you want to click over to the next slide. So as we mentioned earlier, at the end of the year, regardless of whether you're an employee or an independent contractor, you will have to, file a federal tax return typically. For employees, it's a pretty straightforward exercise. You take the W-2 and you report your earnings and tax withholding on your Form 1040. If all you have is a W-2, you may very well be able to use the more simple version of the form, which is a 1040 easy. And just like paying your estimated taxes, you have two options. You can fill out forms the old-fashioned way, print them out from the, you could even pick them up still, I think, from the post office. But you could print them out from the internet, fill them out, or fill them out on your computer and mail them in. Or you can do online filing. And this is important because the IRS actually has a program, which we put the link down at the bottom. The IRS has a program called Free File, where they have sponsored people going online, particularly where it's straightforward, putting in your W-2 information, for example, and anything else. Maybe you have some interest from a bank account or a couple W-2s. You put that information online, it calculates it for you. It tells you sort of whether you have a refund or an amount due. And then you can then input your bank account number. And this is, again, all through the program sponsored by the IRS, which you'll want to go to this website to sort of get to ensure that you're going to the right place. But if you do that, that means you'll likely get your refund faster. So if you've had too much withheld, which is typically the case, you will get your refund faster if you're providing a bank account and you're filing electronically. And then
Can I just interrupt for 1 second? In terms of the amount that people should expect to get as a refund, assuming that they've overpaid, that 15% that you recommended putting away for Medicare and Social Security for the kind of self-employment taxes that independent contractors have to pay.
Yep.
That 15%, what happens to that 15% in terms of the refund?
So typically that you will never get that part refunded. Typically, if the self-employment tax part of your earnings, if you have earnings from self-employment, typically that's not going to get refunded at all. The exception may be, and we'll go into this in a second when we get to the independent contractors, the exception may be if you had expenses that you didn't take into account when you were doing your estimate. So if you overestimated your amount of income somehow, then of course you would get a little bit of that 15% back. But a rule of thumb will be that at a minimum you'll be paying that 15% self-employment tax on whatever you earn for the year as an independent contractor. For employees, it is a little bit more often that employers are going to overwithhold on the income tax portion. And so that means that you could end up with a refund. It's also possible that you could be eligible, Martina, for certain other benefits like earned income tax credit, for example, as either a self-employed person or an employee, which may actually give you more of a refund than whatever income tax you paid in or received back. So in a sense, that could give you a refund, but really it just depends on how your own personal earnings end up for the end of the year. And I think it's safe to assume that 15% will never get refunded.
Great, thank you.
Yep. And then if you go, yep, there you go, perfect. So a big difference, flipping over to the independent contractor side, is that independent contractors are sort of viewed as, by the IRS, as effectively running their own consulting business, or whatever the business may be, but running your own business. And so you have to fill out a separate piece of the Form 1040. It's called a Schedule C. It's called profit or loss from a business. And there's a couple important things. One, you of course would put in whatever the revenue or income was that was reported on that 1099 that we mentioned earlier. You would put that in as your income on the Schedule C. But you may also be able to deduct certain expenses. So if you had travel expenses that related to going to see your client, or if you had to get a phone, or you had to get special kind of data, or you had roaming charges, those kinds of expenses that are directly tied to your consulting business generally would be deductible. So you should save receipts and keep track of what you spend as part of your work. And then at the end of the year, instead of just using the free file program, we typically would recommend that you go see someone who can help you process, particularly if you do want to claim any expenses as part of your Schedule C. So what we recommend is that you look for what's called a volunteer income tax assistance program, and we'll go into more details on the next page, but that'll give you access for free to someone who's been trained by the IRS to help you figure out what is deductible, what isn't. Is there anything else I can be doing to sort of get that tax bill down, and then also make sure that you're doing everything right when you get it e-filed, and we'll e-file it for you. And by e-file, I mean electronically filed. And so one thing that's worth noting, so this is the Volunteer Income Tax Assistance Program. One thing that's worth noting is that they can, volunteers can also prepare your state tax returns. So in the example I used earlier, where you might have to fly to another state and do some work there and then come back to your home state and maybe do some work in one place and some work in another place, if you end up needing to file multiple state tax returns, it is great to go to the Voluntary Income Tax Assistance Program, because that will enable you to have them help you sort out the state tax issues as well. And they can also give you estimated tax forms for the next year. And we included the link here at the bottom so that you can see where to go. And they typically start those programs in early, sort of mid-January. And I think that's it for me. Before I pass it over to Jack, were there any other questions on this part, Martina?
Yeah, so two quick questions, Kat. So first, you mentioned in passing that someone might be subject to backup withholding, and that's a question that you have to answer on the W-9 form. Can you just explain what backup withholding is and why that matters?
Yeah, so if you, and this dovetails very well into what Jack's going to go into, but if you were to, let's say for a second that you didn't do all of these things right for a prior year. Let's say for a second that you didn't realize you needed to pay estimated payments. When it came time to file your tax return, you realized you had a tax bill, you couldn't pay it. But you also didn't cooperate with the IRS. The IRS has the ability to put a lien on all of your future earnings and assets and cause you to become subject to an additional 28% withholding on any earnings. That is often referred to as backup withholding. It's typically at a 28% rate, and generally will apply once the IRS has followed certain procedures for collecting back taxes due.
Okay, and one more question. So someone has asked, when they're on the Form 1040 and there's no place to check self-employed, the question is, should I choose from the options that matches the job description?
Yeah, no, absolutely. So self-employment is really more of a category. So if you are a consultant, I think that's one of the drop-down possibilities. I assume you're talking about on the front of the 1040 where they ask for what your profession is. You could put whatever. So if I was self-employed as a lawyer, for example, I would still just put lawyer, but then I would go fill out the Schedule C, which is attached to the 1040. That would indicate to the IRS that I am self-employed in my capacity as a lawyer, as opposed to now what I get is is I get paperwork, I get a W-2 from my employer. So if I was self-employed, that piece of it doesn't necessarily go into the profession itself, but instead it would get, in effect, it would get conveyed to the IRS because you're reporting your income on a Schedule C rather than on the W-2 line on your 1040.
Okay, got it. Thank you, Kat. And the next question that we have leads entirely into Jack's presentation. So the timing of this one is perfect. The question is, at the end of the day, if all of this is simply overwhelming as an independent contractor, and if someone is 2 years behind, how do you get the help needed to fix the situation? Living at a poverty level does not allow me to withhold anything for later taxes. So, Jack, do you think you can sort of weave an answer to that into your presentation? Thank you.
I think so. Thank you, Martina, and thank you, Kat. The short answer to that is what you just heard about is all basically prospective. It's all about what is going to happen for the current tax year and what is happening in the future. And for a poverty level taxpayer, probably the most effective thing to do is just what Kat suggested. Is to go to one of those volunteer income tax assistance sites. That's for preparing current year returns. And those people will be able to help you work through a Schedule C if you're an independent contractor. What we're going to talk about for the rest of the presentation, I'm going to cover situations where there is already a problem, where the taxpayer is trying to catch up, and especially where the IRS is arguing over the amount the taxpayer owes or is trying to collect from the taxpayer. There's free help available for someone who's at poverty level here, and you'll see a couple of slides of that oncoming. There's a very robust low-income taxpayer clinic program all across the country, and you can see here on the cover slide, I teach at a low-income taxpayer clinic, or LITC, myself. So what I'm going to cover here is, first of all, give you an overview of what tax controversies are, and these are disputes. These are when something has gone wrong. I'll talk a little about some specific kinds that you or a client might run into, and then a few practical tips, particularly things that I've seen come up in having assisted HT clients who have had tax controversies. So, first topic: what is a tax controversy? Well, as you can see on the next slide, tax controversies are disputes between a taxpayer and the taxing authority. So what Kat talked about is transactional tax return preparation. These are situations, what I'm talking about, where a taxpayer and the IRS or the US government or a state taxing authority are fighting. Tax controversies move through multiple stages, both within and outside the IRS. And one thing that you'll see is, as kind of a theme in what I'm talking about here, is that different options become available as stages change, and different options become foreclosed at different stages. I provided for you to the presenters a PDF of a chart that I do for my students called Life of a Tax Controversy. If you have that it's not in the slides, but it was provided as something separate. If you have that handy, you can follow along on that. I won't hit every single thing on that chart. I teach a whole 3-hour course on this in addition to clinic, and we have less than half an hour here. So, major divisions of tax controversy. Generally, they can be divided into disputes as to liability and disputes as to collectability. In a dispute as to liability, the issue is, what is the taxpayer's correct amount of tax liability? How much tax does the person actually owe? What happened during the particular tax period? And and how much tax does the taxpayer owe on it? Some examples that I've got here, and I'll talk very briefly about each of these, are IRS audits, tax court litigation, and tax refund cases. Disputes as to liability tend to occur early in the tax controversy process, and you may come into a situation where a client's time to dispute a tax liability has actually run out, and your only options left will be to raise the matter before the service as a dispute as to collectability. A dispute as to collectability is, okay, we know the taxpayer owes a particular amount. There's a particular amount recorded on the IRS's books. Should the taxpayer be required to pay that liability in full, or immediately? Or is there some reason that the taxpayer should not have to pay right now, or should not have to pay the amount in full at all? And right on this slide, you see 3 examples that I've got that I'll talk about briefly during the rest of my presentation. So, first of all, one more way to divide up tax controversies. In the tax controversy world, we deal both with the IRS as an administrative agency. So the representative or the taxpayer is actually arguing to the IRS. In these cases, there's a strong emphasis on what the agency's procedures are. The IRS deals with literally millions of disputes like this every year, and as much as they would like to, they're not able to individualize things as much as they would like. So there's a strong emphasis on particular checklists that the service has, and an emphasis on documents. There's a distrust of information that comes only from the taxpayer. The service feels much more confident when it's provided with information that comes from some third party. The Internal Revenue Manual that I have mentioned there is something that's not very well known to lawyers, but I wanted to mention that's effectively the IRS's employee handbook. There are also some situations where a tax controversy can be brought into litigation. An argument, cases can be argued before the U.S. tax court. Sometimes they can be argued before the U.S. District Court, although that tends to be for taxpayers who can afford to pay their liability and then sue for a refund. Here, things are a little bit more fluid. The emphasis is on the law of the tax code, and if a representative is attempting to settle a case, on the hazards of litigation in a case. So that's kind of an overview of different kinds of tax controversy. First, let's talk about disputes as to liability. These are not every kind of dispute as to liability that there is. These are just common kinds that come up. And I want to give you some information on how to recognize these. First of all, audit. Tax specialists refer to this actually as exam or examination, which terrifies my students every time that I need to teach them about audit when they see exam on the syllabus. What an audit really is, it's not just the world's most boring experience, it's the IRS effectively asking a taxpayer whether what is on a return that the taxpayer has filed is correct. The service has either gotten information or that calls the return into question, or has just randomly selected the return as a type of return that it thinks might have a problem, and asks the taxpayer to verify some or all of the information on the return. These cases are very, very fact intensive, and like many kinds of tax controversy, but it's particularly important here, they are fact intensive. It's very critically important to make sure that a client, a taxpayer, maintains records as much as possible. Just as Kat was talking about, just as it's important to save a copy of all the payments made to the IRS and save receipts if someone's operating a Schedule C business, this is why that is so important. Two kinds of audits that taxpayers might run into are correspondence, which is handled just by an exchange of letters, and that'll be limited usually to a single issue. There is technically on the letter that the person receives from the IRS a number to call back, but generally that number is not answered. And often if the taxpayer is unable to convince the IRS on just a document, it'll be necessary to take that dispute to the next stage of the controversy world. Office audits are probably what you think of when you think of an IRS audit. That is sitting across the table from an IRS person and handing documents back and forth and explaining the situation with the IRS person saying, well, okay, I believe this, but not that. Taxpayers are frightened by even the word audit, but keep in mind, as you can see on that chart that I handed out, an audit is only the first chance to dispute a tax issue. There are plenty of other opportunities. So the next slide here is how to recognize the audit stage. I often get contacts from clients saying, I'm being audited, and the person is actually long past the audit stage. So here's how to recognize when a case is truly under audit. That's basically, it's a virgin tax controversy case. The a letter saying, we're examining your whatever year income tax return. Notice CP 2000. What that means is every IRS document that comes out will have a notice or letter number somewhere up in the upper right-hand corner normally. If that says CP 2000, that's an audit notice. An audit, so those things are generally signs that an issue is under audit. Sometimes it will say we're auditing your return or we're examining your return. Once the audit stage is finished, once the IRS issues a revenue agent's report, which is also called a 30-day letter, and one of the most important attachments to it is called a Form 886. The reason it's called 30-day letter is the taxpayer then has 30 days to submit a protest, as it's called formally, to the IRS Office of Appeals. That's an independent that's an independent subunit within the IRS that reconsiders decisions of the rest of the IRS. Whereas an auditor, someone from the IRS exam division, is going to be very strictly bound by the service's own legal interpretations and very strictly bound by IRS procedures. If a case goes to an appeals officer, either at this stage or somewhere else, appeals is generally more flexible and willing to consider a wider array of facts that influence the situation than the exam division. They're also willing to consider what might happen if this case went to court and would the service succeed or fail there. So that's audit. The next most common stage is on this next slide here, the United States Tax Court. Let me give you an overview of the tax court before talking about how to get there. This is a specialist court that handles only tax cases. The judges are all tax specialists and tax attorneys. It's based in an ugly, black, threatening building in Washington, D.C. Those who have seen that building know what I'm talking about. But the judges ride circuit. It's one of the few courts that still does that to handle calendars around the country. For example, the tax court comes here to Baltimore 2 to 3 times a year to hear whatever cases have accumulated in that amount of time. It's a tax court case is started with a petition by the taxpayer, or the complaints there are called petitions, and generally the court reviews all issues de novo. So even though the IRS has almost by definition decided some issues against the taxpayer, the judge is taking a fresh look at it. As you can see on that Life of a Tax Controversy chart, there's a little jog over to one side taking cases to the IRS Office of Appeals. Any case that didn't go to the Office of Appeals before, as I was just talking about on that audit slide, will be referred to the IRS Office of Appeals in an attempt to settle it. And even if it doesn't settle with appeals, or if the taxpayer has already been there, IRS counsel, the attorneys for the IRS, prefer to settle a majority of the cases. About 85% of tax court cases settle. The few that do go to trial, 2 hours is a long tax court case. I will also say the U.S. tax court is one of the judicial system's best kept secrets. It is one of the best courts in the country in which to be a pro se party. For instance, the tax court understands that taxpayers don't know the term pro se and instead refer to these people as self-represented. The judges are used to dealing with taxpayers who are representing themselves, and therefore, when a case is called in a calendar, the judges are very active. They'll ask questions of the taxpayer and ask questions of the IRS to fully understand what's actually going on. And volunteer assistance, and usually in most cities, representation is readily available, usually through low-income taxpayer clinics that are attending calendar calls, not only during calls of the calendar, but also before calendar call. The tax court is very good about alerting taxpayers to the availability of free help in their so-called stuffer letters that are sent to taxpayers.
And Jack, can I just interrupt for 1 second, because the chat question area is blowing up with questions.
Yes.
So some folks have asked how it's possible for them as the taxpayer to get copies of, I think it would be the 1096, but to get copies of what independent contractor employers have sent to the government, have sent to the IRS. Essentially, people are asking how they can get their own tax records from the IRS.
Okay, there are a few ways to do that. It's possible to go on irs.gov and look into requesting tax information on there. There is a special form, Form 4506, used to request copies of your own tax return, and there are related forms that can be used to request that information too. It's also possible to make a request under the Freedom of Information Act, and as complex as that sounds, that's actually a relatively simple thing to do. It's simply a matter of drafting a letter that's a couple of paragraphs long and sending it to the appropriate place. That's Freedom of Information Act, or FOIA, F-O-I-A. And again, instructions on that are actually up on irs.gov. The easiest way to get information, though, say that you're an independent contractor and various entities are issuing you 1099s during the year. The easiest way to get information on who's issuing the 1099s and when they were issued and where they came from is to request an IRS transcript. The IRS is currently rolling out a whole new system for doing this. The system has gotten a little bit more complex and involves receiving a text message and then sending one back. So it's most effective if you have a smartphone, and that's just as a matter of identity protection. But what you would want to get that information is called a wage and income transcript. So you would request there are instructions, again, on all this on irs.gov. A wage and income transcript will include, say, all Forms W-2 that were issued to a taxpayer during a particular year, or all 1099s that were issued to a taxpayer during a particular year. There are other kinds of IRS transcripts that can be requested too. For instance, one that I use as a controversy rep frequently is an account transcript, which is basically everything that's happened with regard to a taxpayer's liability for a particular year. So it'll say, was this audited? Was a notice of deficiency issued, et cetera. It's also possible to get someone's own tax return in the form of a transcript. So instructions for getting this, as I said, are available on irs.gov. It does require some electronic registration. I have not done this as a taxpayer, especially on the newest system, and the way it's requested by representatives is somewhat different. I am told by representatives that it's challenging but doable. I have not spoken to a taxpayer who's done it recently because we've been able to do it for them.
And Jack,
but wage and income transcripts.
Can I just jump in with a couple of questions? So one person has said, you know, I've been trying to access my tax information online, but every time I enter my information, I get a screen that says the information is not accessible. Is there a reason why someone might not be able to access their own tax information?
Well, I will say that the system itself for requesting transcripts, the electronic system, is somewhat unreliable. I sometimes will have an IRS power of attorney in on file and won't be able to get the information, and I'll get a message like that. It's also possible there was just a mistake in entering the information. If a taxpayer can't get the information in that way, another option is to call the IRS. I recommend calling a number on an IRS notice or the number for the automated collection service that is up on irs.gov. It's a toll-free number. I do recommend calling first thing in the morning if a taxpayer is going to call about that. The phone line's open, I believe, at 8:30 Eastern time, and generally that's the easiest time to come in or to call in before folks in the rest of the country have started calling in. You can, again, just request a wage and income transcript on there, request other types of transcripts. I am told that for representatives, the IRS will be discontinuing that at the end of this year. And again, this is all due to fear of people stealing taxpayers' identities. The upshot of all this, I think, is that it is actually getting more difficult to request even your own information from the IRS, and it's purely due to fear of information being stolen.
And one person has commented that they were on hold for hours. My longest period of on hold with the IRS was 4 hours. So if you do call in, you should be prepared to wait for a while. I think that's just—
Yes, you should definitely be prepared to wait.
Okay, so
the wait times.
Go ahead.
The wait times tend to be shortest early in the morning.
Okay, and so there's another question.
I'm sorry, I can't hear you.
Sorry. Do low-income clinics, like the low-income tax clinic, do they take on these types of efforts, like getting tax return copies when someone has an issue with the IRS?
Most LITCs, certainly when someone is accepted as a client before trying to resolve any problems, they will get all this information from the IRS just in order to figure out what's going on. Strictly speaking, if there isn't a dispute between the taxpayer and the IRS, that may not be something where the low-income taxpayer clinic can represent the person, but usually they can at least briefly consult with the person and give them some advice for getting the information and recovering it themselves.
Okay, great. So I think that's handled all the questions that have come in on the chat box, so we can keep powering through. Thanks, Jack.
All right. This slide where I'm talking about the U.S. tax court, the notice of deficiency is often called the ticket to tax court. And I'm telling you about this because this is a signal for one of the taxpayer's best options to dispute how much the taxpayer owes. It's also called a 90-day letter because it gives the taxpayer 90 days to petition the U.S. tax court. Things to look for here to recognize one of these things are the words, of course, notice of deficiency, the 90-day period. They're statutorily required to list what the 90th day is, and there will usually be extensive attachments. By the way, to recognize a case that is already in tax court, if someone brings you a case where they've petitioned tax court themselves, look for a caption, look for a typical court front page, but a caption identifying the government side as the commissioner or as the respondent. Those are cases that are pending in tax court. If it's in U.S. District Court, the defendant will be the United States. So those are just some ways to recognize a tax court case if you walk into one as a representative partway through. Our next page here, we're dealing with the alternative route for disputing tax liabilities. This is less often available to low-income taxpayers like I represent because this is a refund claim. The situation here is the taxpayer files an original tax return, the thing that's due on April 15th every year, or an amended return asking for money to be refunded to the taxpayer. Either there was excess withholding over the amount of tax owed, or maybe there was a refundable credit like the earned income tax credit or a few other credits where the taxpayer can actually get more money back than was paid, can be owed in taxes. That is, in addition to being a tax return, that's also a refund claim. The taxpayer is asking for the IRS to give money back. Normally, these need to be filed within 3 years of the time the return was filed, or 2 years from the time the tax is paid, whichever is later. Of course, if your original return is claiming a refund, that isn't going to be a problem. But if an amended return needs to be filed, be sure to watch your timing carefully. And when the IRS receives a claim for refund, it looks at the whole tax return just as if it was auditing the return. On our next page, we talk about refund suits. This is what a taxpayer can do, at least in some cases, if the IRS does not issue a refund that the taxpayer is asked for. If the refund claim is formally denied, the IRS sends out a notice saying, we denied your refund claim, or it sits on a refund claim for more than 6 months without denying or without paying out the money. A taxpayer can file suit for a refund in U.S. District Court. Notice this requirement, the second requirement on here. The taxpayer needs to pay in full before suing for a refund. This is a jurisdictional requirement, and this is what tends to keep a lot of low-income taxpayers out of filing refund suits. Although with a refundable credit like the earned income tax credit, sometimes it's actually possible. Refund suits are nice because they're handled, they're defended on the government side by the U.S. Department of Justice rather than lawyers with the IRS. The Justice Department, I used to handle these kinds of cases back before I became an academic, and the Justice Department tends to take a more holistic view of things. It can therefore be easier to settle some of these cases with them depending on the circumstances. And one nice thing is it's a suit for recovery of money damages. So unlike U.S. tax court, where cases are always decided by the judge, jury trial is available here for the taxpayer. And of course, everyone hates the IRS, so it's a fantastic case to be tried by a jury, at least in the abstract. Okay. More often, in my experience, taxpayers tend to either not open their dispute liability correspondence at all, or file it in the wastebasket, or simply not save it. And the majority of taxpayers who come to me as a representative tend to be further down on that chart that that I provided to you. They're in what I call collection world. So disputes as to collectability. To understand collectability, you need to understand this concept of assessment. It just means that the IRS has recorded a tax liability on its books. It's just an accounting operation. And as I was talking about earlier when I was telling you about transcripts, it's what will show up on an account transcript once the IRS has made a determination. The reason assessment is important is that once a tax is assessed, and there will be a date on that transcript, the IRS will have a particular date on which it's assessed. The IRS has 10 years to collect the tax. Assessment usually happens upon filing a return. If I file a tax return saying that I owe $10,000 in tax and that I paid $9,000 through withholding, the IRS is going to assess the $10,000 against me, include the $9,000 credit toward my account, and send me a bill saying, hey, you owe us $1,000, pay it. If a tax return gets audited, that is, the IRS looks at a return and says, oh, the amount of tax the taxpayer reported on this return was too low. We think that the taxpayer owes more. There may be two assessments. First, an assessment of whatever was reported on the return, and then a second assessment for the same year sometime after the issuance of the 90-day letter. If the person goes to tax court, the liability stays in flux, so nothing will be assessed until the tax court case is over. And if the taxpayer wins in tax court, nothing gets assessed. Be sure to check assessment dates with one of those account transcripts that I mentioned. And as we talked about earlier, taxpayers can request those from the IRS, and so can a representative who has submitted to the IRS's centralized authorization file unit a Form 2848, which is the IRS power of attorney. So with assessment in mind, what does the IRS actually do when collecting? The IRS is much more powerful than your typical run-of-the-mill creditor, but the IRS is fairly lazy as creditors go, compared to, say, your typical private credit card collector, for example. As Kat was saying earlier, once a tax liability has been assessed, a federal tax lien attaches to all property and rights to property of the taxpayer, even if the IRS hasn't filed any notice of lien with the county recorder's office or a similar office. So that's very broad scope, but in most cases, the service does not do very much to collect it. It may or may not levy, that is, seize assets, depending on the specifics of the case. How much does the taxpayer owe? Does the taxpayer have something that's easy to grab, basically cash or a cash equivalent, like payments from an employer or a bank account? Or does the taxpayer only have things that need to be fed, walked, or watered, and therefore that the IRS doesn't want to get its hands on and have to deal with the hassle of? Before the service starts levying, it will issue what's called a collection due process notice, a CDP notice, and that will be captioned Notice of Intent to Levy and Your Right to a Hearing. And there's also a variation when a lien notice is recorded with, say, a county recorder, that's Notice of Federal Tax Lien Filing and Your Right to a Hearing. To recognize one of these things, look for the words Your Right to a Hearing. The IRS sends out things all the time that say Notice of Intent to Levy that are not real notices of intent to levy. They're just notices that, hey, you're owed a refund from somewhere else and we're going to offset it against your existing tax liability. So look for those critical words, Your Right to a Hearing. That allows the taxpayer an opportunity for an administrative hearing with the IRS Office of Appeals to present collection alternatives, and we'll talk about what those are in a second. But before we dive into those, know that even if the taxpayer is past the time to formally respond to a notice like this, a taxpayer can also seek collection relief without such a notice. And in fact, that's a major part of my practice as a low-income taxpayers rep. So here we start discussing collection remedies. These are things that a taxpayer might want to propose in collection cases, ways to either stop the bleeding or maybe resolve the bleeding altogether. First of all, we have installment agreements. These are sometimes colloquially called payment plans. It's an agreement to pay the tax, usually in full, although there is such a thing as a partial pay installment agreement, over time. Usually, the IRS will expect it to be paid within a maximum of 72 months, 6 years. Small dollar installment agreements, and in the IRS's view, small dollar amounts, it does vary depending on a number of different factors that are really beyond the scope of this discussion. But generally, under amounts under $10,000, and especially more recent liabilities that are under $10,000, that can actually be submitted online as a so-called streamlined installment agreement, especially if the taxpayer is willing to have the monthly payments taken directly out of a bank account. Larger installment agreements for larger dollar amounts, or if a taxpayer wants to pay over a longer period of time or wants to pay with a check every month, they're going to require substantiation, like an offer, which is what we cover on the next slide here. Offers in compromise. This is an agreement to resolve the tax liability for less than the full amount due. This is the proverbial settle your tax debt for pennies on the dollar. I don't want to get people's hopes up here. That certainly does not happen and cannot happen in every case. But yes, it does happen. There are cases where if a person's income and assets are low enough, it is actually possible to compromise something down from the many thousands of dollars down to $1,000 or $100 or $1. That tends to be for low-income taxpayers. If a client is not a low-income taxpayer, that's probably not happening. But the principle of the offer in compromise is the same. This is a payment for a lump sum or to be paid over time. Again, they're normally going to want it within a couple of years, usually within a maximum of 5. These aren't guaranteed. This is something where the taxpayer actively has to make a request of the IRS. And I routinely deal with situations where clients talk to my student attorneys. They've already become a client and signed a retainer agreement and said, well, why can't you just, we talked about doing an offer in compromise. Why can't you just call up the IRS and ask for it? It's much more involved than doing that. Extensive substantiation is required. And you see that at the bottom. The taxpayer and the representative together need to fill out this IRS form here, this form 433A-OIC. That lists the taxpayer's assets, bank accounts, car, house, whatnot, liabilities, monthly income, monthly expenses, and it gives an overall financial picture of where the taxpayer is. Gathering records is very important here, needless to say. There are a lot of attachments required, and so it requires significant client participation. It's also, and all that stuff is required in order to get the IRS to exercise its discretion to grant the offer. Notice that a taxpayer also has to be what we call in compliance. All past tax returns need to be filed. And as Kat was talking about, current estimated taxes, if any, need to be paid. This can mean that if you're a low-income taxpayer and you're self-employed, it can be difficult to make an offer in compromise because it can be very difficult to catch up with your estimated tax payments. One thing that I routinely counsel clients is to be sure to stay current on your estimated tax payments. Especially if you're looking to seek collection relief. Without that, getting collection relief isn't going to be possible. On our next slide here, we have the 3 major different kinds of offers in compromise. Doubt as to liability is something that isn't used very much. There, the taxpayer's argument is, I don't actually owe this tax. That usually is not the best option for taxpayers. Normally, it's best to fight that during the liability stage of a case, like I talked about much earlier. Doubt as to collectability is much more common. It's simply, I can't afford to pay this. If the numbers on that form I described come out showing that the taxpayer has very low or negative monthly income, and especially if the taxpayer doesn't have any assets that could be used to be sold off and used to pay down the liability, the service will often accept a doubt as to collectability offer. Then finally, we have this oddball catch-all variation, effective tax administration. What this means is, this is the way I describe it. On paper, I can afford to pay this liability. The numbers on the form came out saying I still have some money left over and I could afford to pay it in full or in significant part. But there's some special reason that the IRS shouldn't require me to pay in full. And I've got just 2 examples of that listed down here. One common one that we deal with in the low-income taxpayer world a lot is economic hardship. That's a situation where paying the tax would leave a taxpayer destitute. For instance, Maybe a taxpayer is retired and doesn't really have any significant earning potential, and working in Maryland, a very high cost of living and high asset state, maybe the person is very house rich. They own a house that's appreciated to hundreds of thousands of dollars, but that's the taxpayer's only asset. And if the person were forced to liquidate their house, they wouldn't have anywhere to live. That might be an economic hardship case. I also mentioned this public policy situation here because this is an HT presentation, and there are many kinds of public policy ETAs, but one of them that I have seen in past HT cases is a situation where the liability arose due to the crime or fraud of a third party. So the liability isn't the taxpayer's fault. Some third party actually caused the taxpayer to incur the liability, like by forcing the taxpayer to file false returns. Finally, we have currently not collectible status, just what it sounds like. The IRS determines it can't reasonably collect from the taxpayer at this time. There's just no money there. Effectively, what the taxpayer is doing here is waiting for that 10-year collection clock to run out. The taxpayer will receive an annual reminder of balance due saying, hey, you still owe this tax liability. We're not collecting right now, but you still owe it. The taxpayer won't be able to get his or her hands on any refund that the taxpayer is owed during that 10-year collection period because the refunds will be offset against the liability. The IRS does annually reevaluate the taxpayer's situation in case the taxpayer wins the lottery, as they always put it to me. I have never seen anybody pulled out of currently not collectible status on that basis, but if financial circumstances change, it could happen. And notably, interest continues to accrue here, but